Usually, when we think about a matchmaking service, there is this expectation of romance.
Right. Yeah, like a cozy dinner, two people hoping to find a spark.
Exactly. Maybe a bit of, awkward conversation over appetizers. It is highly personal. You are trying to pair two compatible individuals based on a whole host of intangible, unpredictable qualities.
But step into the world of macroeconomics and corporate finance, and that matchmaking service, well, it drops the romance entirely.
Yeah, completely gone.
We are looking at a landscape that is just as intricate, if not more so. But instead of matching lonely hearts, we are matching something far more pragmatic. We are matching capital.
Capital, right. And if you are an MBA student gearing up to master the Indian financial system for your exams, just brute force memorizing a bunch of definitions is going to fail you on exam day.
Oh, absolutely. Your brain will just reject it.
Yeah, you need to understand that this entire system is, at its core, a high-stakes matchmaking engine. On one side, you have the savers, right? The entities with surplus wealth.
Yep, the ones holding the cash.
And on the other side, you have the builders, the investors, the corporations, and the borrowers who are, like, desperate for that wealth to innovate and grow.
And that gap, between savings and investment, that is the fundamental problem of any economy. I mean, if the wealth just sits in a vault, the economy stagnates.
It does nothing.
Right. So the financial system is the bridge. It is the tool of economic development that enables lenders and borrowers to exchange funds, thereby actually creating wealth.
And if you walk into your exam room, really understanding the mechanics of that bridge, the specific terminology will just naturally fall into place.
It becomes intuitive, yeah.
So to build that mental map for you today in this deep dive, we are going to explore the specific framework that categorizes this whole system into four main pillars.
The four pillars, exactly.
Right, so we have the markets, the institutions, the instruments, and the services. Yeah. And then finally, the regulatory guardrails that kind of keep the whole engine from exploding.
Think about it as a logical progression. We need arenas where the activity actually happens.
The physical or digital spaces, yeah.
Right. And we need players who facilitate the activity. We need tools for them to use. We need specific types of transactions. And of course, we need referees to enforce the rules.
I like to visualize this like a massive, bustling city's infrastructure. In this analogy, the markets are the different neighborhoods or districts where commerce actually happens.
Like the wholesale districts versus the retail districts.
Exactly. And the institutions, so the banks, the mutual funds, they are the heavy vehicles driving around this city, moving resources from point A to point B.
That makes the instruments, like the shares and bonds, the actual cargo inside those vehicles.
You got it. And the services like leasing or factoring, which we will get deep into a bit later, those are the delivery contracts or the logistical arrangements dictating exactly how that cargo is handed over.
That architectural analogy works perfectly, really, especially because the health of that city's infrastructure directly dictates the growth of the economy itself.
They're completely tied together.
Entirely interdependent. I mean, you cannot have a booming industrial sector if your financial infrastructure is composed of, like, dirt roads and horse-drawn carriages.
So true. Well, let us start by walking into the first neighborhood of our city, the arenas. The financial markets.
The lifeblood of an economy.
Right. This is where the mobilizers of financial resources live, a space where people trade financial securities, commodities, and other items of value based purely on the laws of supply and demand.
And we should probably clarify a fundamental distinction right away for the exam.
Oh, definitely.
Securities refer to paper or, well, digital claims these days, like stocks and bonds representing ownership or debt. Commodities are physical assets.
Like precious metals, crude oil, or agricultural products.
Right. But whether you are trading a complex derivative contract or just a ton of wheat, the underlying principle of the arena is price discovery. The market exists to figure out exactly what an asset is worth at any given second.
Now, here is a massive conceptual divide in the financial markets, and it is like a guaranteed exam topic. You absolutely must have this locked down.
The big split.
The split between capital markets and money markets.
Oh, yeah. Mixing these two up on an exam doesn't just lose you points. It demonstrates a fundamental lack of structural understanding to your professor.
It's a huge red flag.
Exactly. The dividing line between the two is incredibly simple, but the strategic implications for a business are just vast. It all comes down to time.
Time. The greater than 1 year rule versus the overnight to 1 year rule.
Right.
Let's look at capital markets first.
Okay, the long game.
Right. This is the financial market for long-term loanable funds. This is where you go when you need money for a period exceeding 1 year, sometimes extending into, like, decades.
Let's invent a hypothetical company to track through this whole deep dive. We will call them Harat Build Tech.
I like it.
Let's say they are a startup manufacturing modular housing materials. Now, if Harat Build Tech is building a new state-of-the-art manufacturing plant, they don't need funds for a week.
No, of course not.
They need capital that they can put to work, sink into concrete and heavy machinery, and slowly pay off over 5, 10, or maybe 20 years.
So the capital market is where corporates, like our hypothetical Harat Build Tech, go directly to investors to raise these long-term funds.
Exactly. And because we are dealing with long-term risk and public investors, this specific arena functions under the strict regulatory supervision of SEBI.
The Securities and Exchange Board of India.
Right. We'll get to them in detail later, but just know they are the ultimate referee here.
So if capital markets are the long game building the factory, what is the money market doing with its overnight to 1 year rule?
Well, these are instruments that act as close substitutes for money. You know, treasury bills, call money, commercial paper, certificate of deposits.
So the contrast in purpose is fascinating. You aren't building a factory with money market funds.
No, not at all. You are managing liquidity. You are ensuring that you have enough cash on hand to meet immediate short-term obligations without having to, like, liquidate your long-term assets.
Okay, let me test an analogy on you for this one.
Sure, go ahead.
If capital markets represent the grand opening of Harat Build Tech, raising the massive millions to build the foundation, is the money market basically the corporate equivalent of checking your couch cushions for overnight cash to pay the pizza guy?
Yes. Actually, that's a very precise way to think about it. Just, scale it up to billions of rupees.
Right.
Let's say Harat Build Tech is now a massive corporation. They have a temporary mismatch between their cash inflows and outflows.
Like a timing issue.
Exactly. Payroll for their 5,000 employees is due tomorrow, totaling millions, but a massive payment from a major government contract doesn't clear the banking system until Friday.
So they aren't broke. Their balance sheet is incredibly healthy. They just have a 48-hour liquidity gap.
Exactly. And it would be absurd to issue new 10-year bonds in the capital market just to cover a 48-hour payroll gap.
Right. The paperwork alone would take months.
Yeah, so they check the couch cushions of the financial system. They turn to the money market. They might issue commercial paper, which is a short-term, unsecured promissory note, to bridge that exact gap.
So they borrow the money on Wednesday, pay their staff on Thursday, receive their government check on Friday, and then just pay back the commercial paper on Monday.
Smooth and efficient.
Now, a major exam prep connection regarding the money market revolves around why commercial banks are massive players here.
Oh, this is a crucial point for the students.
Yeah. Banks deal in the overnight market constantly to fulfill their CRR, the cash reserve ratio, and their SLR, the statutory liquidity ratio.
As mandated by the Reserve Bank of India, the RBI.
Right. But to understand why, you kind of have to look at the daily life of a bank.
Yeah, the RBI mandates that banks must hold a certain percentage of their total deposits in liquid cash or highly liquid government securities at all times.
And this is basically a systemic safeguard to prevent bank runs, right?
Yeah, exactly. But a bank's deposit levels fluctuate every single second of the day as customers deposit paychecks or withdraw cash.
So picture a bank manager at like 4:00 p.m. They look at their ledger and realize, uh-oh, a massive corporate client just withdrew 50 million rupees, and now our cash reserves have dipped slightly below the RBI's mandatory CRR.
And they can't just close their laptops and go home. Being below the CRR is a severe regulatory breach.
The RBI would come down on them hard.
Oh, absolutely. So
Huh.
what do? They go to the money market, specifically the call money market. They call up another bank that happens to have excess cash that day, and they borrow the 50 million rupees just for the night.
Just to tide them over.
Right. They pay an overnight interest rate, meet their regulatory requirements, and square everything away the next morning when new deposits come in.
Which perfectly explains why the money market is heavily regulated by the RBI.
Yeah.
It is literally the central nervous system of daily banking liquidity.
It really is. But it is also worth noting that the Indian money market is structurally considered undeveloped compared to some Western markets.
Undeveloped in what sense?
Well, it is characterized by a small number of very large players. You and I aren't trading call money.
Right. I'm certainly not making overnight million rupee loans.
Exactly. It's the organized sector, the RBI, commercial banks, development banks, and massive non-banking finance companies moving enormous blocks of short-term liquidity.
Okay, so that's the short term sorted. Now, let's pivot away from overnight liquidity and head back to the capital markets, because there is a critical subdivision there that dictates how new wealth is actually created.
The primary versus the secondary market.
Exactly. The capital market is split right down the middle there. The primary market, also known as the new issue market, this is a dynamic financial reservoir heavily utilized by newly established or rapidly expanding businesses.
This is where brand new securities are born.
Right, issued to the public for the first time. You've got your public issues, rights issues, private placements, book building, and buyout deals.
And if you are taking notes for your exam, highlight the word born. In the primary market, the transaction is directly between the company and the investor.
Cut out the middleman well, mostly.
Exactly. Farat Buildtech needs capital, so they create brand new shares of ownership. The investor hands cash to Farat Buildtech, and Farat Buildtech hands a freshly minted share to the investor.
But how does a company actually pull that off? I mean, they don't just set up a folding table on the sidewalk with a sign that says shares for sale.
No, definitely not. There is a massive mechanical process behind a new issue.
And we have a mnemonic to help you remember the three functions of the primary market: IUD investigation, underwriting, and distribution.
Let's break down the I first, investigation. A company like Farat Buildtech doesn't just blindly ask for 1 billion rupees.
Right. Investors would laugh them out of the room.
Exactly. The investigation function entails rigorous research to ensure the capital issue is financially sound. It comprises studying the technical, economic, financial, and legal feasibility.
So, will this new factory actually generate a return? Is the legal structure sound?
Yes, this due diligence is critical because investors demand transparency.
Okay, so they investigate and prove the business model is solid. Next is U for underwriting. Now, this is a word that gets thrown around constantly in finance, but what is the actual mechanical reality of underwriting in the primary market? It's essentially a guarantee, right?
Think of underwriting as a high-stakes insurance policy for the company trying to raise money.
Okay, how so?
Well, let's say Farat Buildtech wants to raise 1 billion rupees by selling 10 million new shares at 100 rupees each, but the founders are terrified. What if the market is having a bad week?
Oh, and nobody wants to buy.
Right. What if they only sell half the shares? They'd only raise 500 million, which isn't enough to finish the factory, leaving them completely stranded.
That is a total nightmare scenario. You have a half-built factory and no cash left to finish the roof.
Exactly. To prevent that, an underwriter, usually a major investment bank, steps in. They analyze the investigation report and they say, "We guarantee you will sell all 10 million shares. We will underwrite this issue."
And if they don't?
If the public only buys 8 million shares, we, the investment bank, are legally obligated to buy the remaining 2 million shares ourselves with our own money.
But wait, investment banks aren't charities. Why on earth would they take on the risk of buying shares the public clearly doesn't want?
Because of the commission.
Ah, the fee.
Yes, they charge a hefty fee for providing that peace of mind. And frankly, the investment bank believes they have the market power and sales force to ensure those shares do sell, which brings us perfectly to the D.
Distribution. The wide geographic spread of share applications. I mean, you can have the most thoroughly investigated, perfectly underwritten share issue in the history of capitalism, but if no one knows about it, it fails.
This is where brokers and syndicates come into play. They are the distribution network.
The boots on the ground.
Exactly. They have access to millions of retail and institutional investors. They push the prospectus out, they drum up excitement, and they physically or digitally facilitate the collection of funds from an unlimited geographic area.
So that is your IUD investigation to prove the worth, underwriting to guarantee the funds, and distribution to actually sell the paper.
A perfect summary.
Now, once those shares are born, distributed, and owned by investors, Farat Buildtech has its billion rupees. They go off to build their factory. But what about the investor?
The person holding the paper.
Right. What if, a year later, the investor needs to buy a house and wants their cash back? They can't exactly ask Farat Buildtech for a refund.
And that is the exact reason the secondary market exists. The secondary market is where existing, already born securities are bought and sold among investors, primarily through stock exchanges.
So Farat Buildtech is no longer involved in the transaction at all.
Nope. Investor A just sells the share to investor B.
This highlights a classic exam question topic: the symbiotic relationship between the primary and secondary markets. They are entirely interdependent. The growth of one fuels the other.
It really boils down to one word: liquidity.
Lucidity, right.
If you are an investor looking at Bharat BuildTech's primary issue.
Yeah.
You are only going to hand over your cash if you have absolute certainty that you can sell that share instantly on a Tuesday afternoon 5 years from now if you need to.
A strong, active secondary market provides that exact exit strategy.
Exactly. If the secondary market was weak or, non-existent, investors would be paralyzed. They'd never buy new issues because their money would be trapped in the company indefinitely.
To understand the sheer velocity and scale of this secondary market in India, we have to look at the big two stock exchanges.
The titans.
Yeah. There are actually 21 recognized stock exchanges in India, but the overwhelming majority of the oxygen is consumed by the BSE, the Bombay Stock Exchange, and the NSE, the National Stock Exchange.
The historical contrast between the two is striking, honestly, and it mirrors the evolution of the Indian economy itself.
How so?
Well, the BSE is a legacy institution. It is the oldest stock exchange in Asia, founded under a banyan tree in 1875.
Literally under a tree.
Literally. It represents the historical foundation of Indian capital trading. The NSE, however, is a modern powerhouse. It was incorporated in 1992 and started trading in 1994.
Oh, so much more recent.
Very recent. It was specifically designed to bring fully automated, screen-based trading to the entire country, breaking the monopoly of those regional trading floors.
Yet, despite the century-plus age difference, they now essentially follow the exact same trading mechanisms, the same trading hours, and the same rolling settlement processes.
And they are tracked by their massive respective indexes.
Right. For the BSE, it's the Sensex, which is the oldest market index for equities in India, tracking 30 deeply established companies. And for the NSE, it's the S&P CNX Nifty, tracking 50 companies.
And the growth of these markets is just staggering. Look at the data provided for the BSE. In the 2010 to 2011 period, there were 5,067 listed companies.
Wow. Okay.
By the 2016 to 2017 period, that number climbed to 5,834.
That is nearly 6,000 individual corporations representing trillions of rupees, with millions of shares constantly changing hands every single day based on global news, earnings reports, and pure supply and demand.
That is the engine of the secondary market right there.
So we have the arenas mapped out: the capital market for long-term growth, the money market for short-term liquidity, the primary market for birthing securities, and the secondary market for trading them.
But an arena is just an empty stadium without the players.
Exactly. Which means we need to look at who is actually facilitating all this capital movement. The second pillar, the institutions, the matchmakers.
A financial institution is basically an entity that conducts transactions such as loans, deposits, and investments. They are the essential intermediaries sitting between the capital market and the debt market.
For the MBA student, you are going to encounter a detailed taxonomy of banks. It's a classification breakdown that looks like an incredibly dense family tree.
It can be overwhelming on a textbook page.
Yeah, so we need to walk through it logically so you can visualize the hierarchy on an exam without panicking.
Let's start at the absolute top of the pyramid, the apex authority, the central bank.
In India, that is the Reserve Bank of India, the RBI, it was established in April 1935 during the British Raj and nationalized on January 1st, 1949, shortly after independence.
It is the supreme authority responsible for the smooth supervision of the entire banking industry.
Below the RBI, the tree splits into two major branches: scheduled banks and non-scheduled banks.
And the critical difference here is simply whether the bank's name is included in the second schedule of the RBI Act of 1934.
Just a literal list.
Yep. Scheduled banks meet specific capital requirements and enjoy certain privileges, like borrowing from the RBI at the bank rate.
Let's focus on the scheduled banks, because that's where the massive economic listing happens.
The scheduled branch splits again into commercial banks and cooperative banks.
Let's trace the commercial branch first. This divides into four distinct categories: public sector banks, private sector banks, foreign banks, and regional rural banks.
Within the public sector, where the government holds a majority stake, one institution really stands above the rest: the State Bank of India, or SBI.
The giant.
It is the largest and oldest commercial bank in the country. Alongside the SBI and its associate banks, you have other nationalized banks. Then you have your private sector banks, driven purely by private shareholders, and foreign banks operating branches in India.
But what about the cooperative branch of the scheduled banks? Why do we have a separate system parallel to commercial banking?
Cooperative banks operate on a completely different philosophy. They are formed by individuals belonging to the same local community or sharing a common professional interest.
So not just about maximizing shareholder value.
Exactly. Their primary goal isn't maximizing profit for distant shareholders. It's providing accessible credit and banking services to their own members, often in rural or semi-urban areas.
And how are they structured?
They are tiered into state cooperative banks at the top, central cooperative banks at the district level, and primary credit societies at the village level.
Finally, we have a specialized branch, completely separate from the standard commercial cooperative divide, specialized banks.
These are interesting. These are institutions engineered for very specific sectors of the economy that require tailored financial products.
Like what?
You have development banks, investment banks, industrial banks, land mortgage banks, exchange banks, XCM, which is export-import banks, and retail banks.
If you can visualize that tree central RBI at the top, splitting into scheduled and non-scheduled, with scheduled breaking down into the massive commercial and the community-focused cooperative,
Yeah.
alongside the new specialized banks, you have the foundational players mapped out.
But banks are not left to their own devices.
No, not at all.
They are watched closely. There are 5 major regulatory institutions that we can call the Big Five.
On an exam, you need to instantly differentiate the specific jurisdiction of each of these 5 regulators. You don't want to say the RBI regulates the stock market. You need memory hooks.
Let's run through them. Number 1, SEBI, the Securities and Exchange Board of India, established in 1992.
And your memory hook here is the investor protector. If a company is issuing shares, if brokers are trading bonds, if mutual funds are pooling money, SEBI regulates the securities market and protects the people investing in it.
Number 2, the RBI. We just discussed them as the top of the banking tree, but their regulatory hook is the monetary controller.
Like, they don't care about the stock market. They care about the money supply, the value of the rupee, the repo rate, and supervising the commercial banks and NBFCs.
Number 3, the Ministry of Finance. This is the government itself. Think of them as the macro manager.
They aren't in the weeds of daily bank operations, are they?
No, not at all. They handle overarching financial legislation, government finances, taxation policy, and the massive union budget.
Number 4, the Ministry of Corporate Affairs. Your hook here is the rulebook enforcer. They administer corporate law.
Specifically, they enforce the Companies Act 2013, the Limited Liability Partnership Act 2008, and the Competition Act 2002.
So if you want to incorporate a business, merge with a rival, or file your corporate structure, you deal with them.
Exactly. And number 5, IRDA, the Insurance Regulatory and Development Authority of India.
The easiest hook for this one, the insurance watchdog. They regulate the insurance industry, protect policyholders from predatory practices, and lay down strict codes of conduct for insurance companies and brokers.
So SEBI for stocks, RBI for money, Finance Ministry for the budget, Corporate Affairs for company law, and IRDA for insurance. Keep those 5 lanes strictly separated in your mind.
Now, speaking of the RBI's lane, we need to address a classic multiple-choice trap that trips up MBA students constantly.
Oh, I know exactly what you're talking about.
The nature of NBFCs, non-banking finance companies.
This is a really tricky area because NBFCs do a lot of things that look exactly like what a bank does. An NBFC is a company registered under the Companies Act 2013, engaged in the business of loans and advances, acquisition of shares, stocks, bonds, hire purchase, or insurance business.
Right, they lend money and invest in securities. So if I'm taking a test and a question asks me to identify the primary difference, where is the trap?
The trap is in what they are explicitly excluded from doing as their principal business.
Huh?
An NBFC cannot have agriculture, industrial activity, or the sale, purchase, or construction of immovable property real estate as its principal business.
Wait, let me push back on this. Why wouldn't the RBI let an NBFC focus primarily on agriculture or real estate? Those are massive sectors of the Indian economy. It seems counterintuitive to ban finance companies from focusing on them.
It all comes down to systemic risk and the nature of an NBFC's funding.
How do you mean?
Well, unlike a commercial bank, NBFCs usually cannot accept demand deposits, the everyday savings accounts of average citizens. They rely on wholesale funding, borrowing massive amounts in the money markets to lend out.
And the risk.
Agriculture is incredibly volatile. A bad monsoon season can wipe out a harvest, leading to massive loan defaults. Real estate is highly illiquid. You can't exactly sell a half-built skyscraper overnight to pay off short-term debt.
Ah, I see. So if an NBFC has short-term liabilities money it owes to the market next month, but all its assets are tied up in a 5-year real estate project or a failed crop, it just collapses.
Precisely. The RBI intentionally isolates those highly volatile or illiquid sectors away from the core principal business of NBFCs to prevent a shadow banking collapse.
So if you get an exam question asking which of the following can be the primary business of an NBFC, and the options are equipment leasing, agricultural lending, or real estate construction. The last two are illegal as a principal business. It has to be equipment leasing.
That is phenomenal insight for the students to remember.
To round out the institutions, we have mutual funds and development financial institutions, or DFIs.
Mutual funds pool money from millions of retail investors to purchase a diversified selection of securities.
And they generally fall into four categories, right? Money market funds for safety, bond funds for fixed income, stock or equity funds for growth, and hybrid funds that mix them.
Yep. And they can be actively managed by a human picking stocks, or passively managed, just tracking an index like the Nifty 50.
But DFIs require a sharper focus. Development financial institutions like IDBI, IFCI, ICICI, and NHB.
These entities were created to fund the massive nation-building projects that commercial banks generally avoid. Infrastructure, rural development, heavy industry.
Projects that might not show a single rupee of profit for 20 years.
Exactly. And here is the exam keyword alert. If DFIs are funding billion-dollar hydroelectric dams, where do they get the cash?
Because they aren't your local bank branch.
Right. They do not accept deposits from the public.
That is their defining trait. A DFI mobilizes funds by issuing their own long-term securities in the primary capital market and by securing massive loans from international bodies like the World Bank or the government.
They borrow wholesale, and they lend for long-term development.
Okay, we know the arenas where capital trades. We know the matchmakers and the institutions moving the pieces. Now we look at the actual gears. The third pillar, the mechanics of financing.
Services.
What specific products are these institutions selling to help a business acquire assets?
This is where theory hits the factory floor. If our hypothetical company, Farat Buildtech, needs to acquire a 50 million rupee fleet of delivery trucks, they aren't going to just pay cash.
That would destroy their liquidity.
Exactly. They need a financial service to structure that acquisition.
And this introduces us to what I like to call the tricky triplets: hire purchase, lease financing, and installment sale.
Oh, this is a minefield for students.
It really is. Because to a normal person, these three sound completely identical. You make monthly payments, you get to use the trucks. But for an MBA student, confusing these will destroy your grade.
You have to differentiate them based on one fundamental legal concept: the transfer of ownership.
Who actually holds the title to the asset, and when?
Let's analyze hire purchase first. In a hire purchase system, the buyer pays for the product by regular installments and enjoys immediate use of it.
Sounds standard so far.
But here is the critical legal feature. During the entire repayment period, the ownership of the item remains with the vendor or the finance company.
So if Farat Buildtech gets 10 trucks on hire purchase, they get to paint their logo on them, drive them around, but legally, every installment they pay is treated as a hire charge.
A rental fee.
Exactly.
Farat Buildtech only becomes the legal owner of those trucks upon paying the very last installment. The final payment is the trigger that actually transfers the title.
And the consequence of that is brutal if things go wrong. Because the vendor retains ownership throughout the entire 3 or 5 year process, the vendor has the unilateral legal right to repossess those trucks immediately if Farat Buildtech misses an installment.
Right. They don't need a lengthy court foreclosure. The trucks still belong to them.
So that's hire purchase. Ownership transfers at the absolute finish line. Now let's contrast that with lease financing.
A lease is a source of medium and long-term financing where the owner of the asset, the lessor, gives another person, the lessee, the right to use that asset against periodical payments called lease rentals.
Under a lease, the ownership always lies with the lessor. There is no automatic transfer of title.
Never.
At the end of the lease, you hand the trucks back, or maybe you negotiate a separate transaction to buy them at their current market value, or you just renew the lease.
To make it more complex, the financial world divides leases into two distinct subtypes: the finance lease and the operating lease.
Let me see if I have this right. A finance lease is basically a stealth purchase. You aren't legally buying it, but economically you are. The lessor transfers substantially all the risks and rewards of ownership to you, the lessee.
Right. It has a primary non-cancelable period where the lessor recovers their entire initial investment plus interest.
So in a finance lease, Farat Buildtech is on the hook. If the truck engine blows up, Farat Buildtech pays to fix it. The lessor is just a financier. They don't care about the asset's condition. They just want their guaranteed financial return over that non-cancelable period.
That's correct. So how does an operating lease, which is sometimes called a service lease, differ?
Well, an operating lease is much shorter, and the risks and rewards are not transferred, right?
Exactly. The term of the lease is significantly shorter than the economic life of the truck. This means the lessor doesn't recover their full investment from Fred Buildtech's rental period alone. They intend to lease that truck to 3 or 4 different companies over its lifespan.
And because the lessor intends to lease it again, they care deeply about its condition.
Precisely. In an operating lease, the lessor usually provides repair, maintenance, and technical know-how. If the engine blows up on an operating lease, the leasing company is often the one dispatching the mechanic.
Okay, so we have hire purchase ownership at the very end and lease financing, no automatic ownership, split into finance where risk is transferred, and operating where service is included.
Perfect. Now for the third triplet, installment sale.
This is most commonly seen in real estate or massive machinery purchases.
Right. In an installment sale, the buyer agrees to make regular payments to the seller over time with interest added on. But the fundamental legal difference is that ownership often transfers immediately at the time of the contract, but the debt is structured over time.
Let's say Bharat Buildtech is buying a massive plot of land for their factory from a private seller. Why would the seller agree to an installment sale instead of demanding the 50 million rupees up front?
Tax strategy and cash flow management.
Right. Just taxes.
It's huge. Receiving a massive lump sum of cash sounds great, but it triggers an enormous immediate capital gains tax liability. Furthermore, the seller now has to figure out where to safely invest 50 million rupees all at once.
Oh, that makes sense.
By using an installment sale, the seller spreads their tax burden over a decade, and they receive a steady, predictable income stream with a lucrative interest rate attached.
So for your exam, when evaluating asset acquisition, hunt for the key words about when the title transfers and who holds the maintenance risk. That breaks the tricky triplets wide open.
Absolutely.
Moving on, we need to talk about the corporate fixers. Merchant banking.
We have to clearly distinguish merchant banks from standard commercial banks. If you are an individual wanting to open a savings account or get a car loan, you go to a commercial bank.
They accept deposits and lend money, making their profit on the interest rate spread.
But if Bharat Buildtech wants to issue an IPO, an initial public offering, and go public, they can't just walk into their local commercial bank branch. They have to hire a merchant banker.
Merchant banks offer sophisticated financial services for a fee. They do not act as repositories for the savings of individuals.
Right. They manage securities issues, handle corporate portfolio services, perform underwriting, arrange massive credit syndications, and provide project counseling.
They are the architects of the primary market we discussed earlier. They do the investigation, arrange the underwriting, and manage the distribution. They don't lend you their depositors' money. They charge you millions in advisory fees to help you extract money from the capital markets.
Exactly. Now we arrive at a mechanism that is perhaps the most practical daily lifeline for mid to large businesses. It is an asset-based financing method called factoring.
It is brilliant, but highly misunderstood.
Let's break it down.
The formal definition is an outright purchase of credit-approved accounts receivables, with the factor assuming bad debt losses. But to strip away the jargon, I think of factoring like a highly specialized pawn shop or a high-finance cash advance service for corporate IOUs.
Let's run Bharat Buildtech through a factoring scenario to make it concrete.
Okay, lay it out.
They have just manufactured and shipped 20 million rupees worth of modular housing to a massive government housing project. They issue the invoice, but the government's payment terms dictate they won't actually cut the check for 90 days.
This is the classic corporate choke point. Fred Buildtech is highly profitable on paper, but they have zero cash in the bank today. They need to buy more cement, they need to pay their factory workers, but their 20 million rupees is trapped inside an invoice maturing in 90 days.
So they go to a factor, a specialized financial intermediary. Bharat Buildtech sells that 20 million rupee invoice to the factor today.
Just sells the piece of paper.
Right. The factor buys it at a discount, advancing them, say, 18 million rupees in hard cash immediately. Bharat Buildtech pays its workers and buys cement.
And the factor?
The factor waits the 90 days, collects the full 20 million from the government, and pockets the 2 million rupee difference as their fee and interest.
You are converting your book debts, your tied-up accounts receivable, into immediate usable liquidity, and the factor essentially performs the financing and the headache of debt collection for you.
Exactly.
But for an MBA exam, knowing the basic pawn shop concept isn't enough. There are 7 distinct types of factoring arrangements based on how the risk and mechanics are structured. We need to walk through each one.
This is a heavy memorization section, so let's take it step by step. Let's start with the baseline risk split. Type 1 is recourse factoring.
Recourse.
Right. In this scenario, the credit risk remains with the client, Bharat Biltech. If the government suddenly defaults or the housing project goes bankrupt and refuses to pay the invoice, the factor has recourse.
Meaning they come back to the client?
Yes. They come back to Bharat Biltech and say, the invoice you sold us is worthless. Give us our 18 million rupees back.
Yikes. Okay, type 2 is the exact opposite. Non-recourse factoring, which is historically known as old line factoring.
Right. Here, the factor absorbs the bad debt risk entirely. If the government doesn't pay, that is the factor's problem. Bharat Biltech keeps the 18 million rupee advance and walks away clean.
But wait, if I'm acting as Bharat Biltech, why wouldn't I demand non-recourse factoring every single time? It sounds infinitely safer.
I assume because the factor isn't stupid.
Right.
If they're absorbing the total risk of a 20 million rupee default, they're going to charge an exorbitant discount fee. Instead of giving you 18 million, they might only advance you 15 million. You have to weigh the cost of that premium against your confidence that the client will actually pay.
Ah, okay. Risk is always priced into the discount rate. Makes sense. Moving on, type 3 is advance factoring.
This is straightforward. The factor pays the cash advance immediately upon taking the invoice, providing that instant financial accommodation we discussed.
Type 4 is where the psychology of business comes in, confidential or undisclosed factoring.
This one is interesting.
Yeah, in a normal factoring arrangement, the factor notifies the end customer, the government, to send the payment directly to the factor. But maybe Bharat Biltech doesn't want the government to know they are cash-strapped and using a factor. It might make them look weak or unstable.
Exactly. So, in an undisclosed factoring arrangement, the factor remains invisible. The government pays Bharat Biltech directly, exactly as normal, and then Bharat Biltech acts as a trustee, immediately passing those funds through to the factor.
It preserves the illusion of total financial independence.
Right. Type 5 is maturity factoring. Now, this one can be confusing at first. The factor doesn't pay you an immediate cash advance. They agree to pay you on a specific future date or the exact date the bill matures.
So if you aren't getting immediate cash, what is the point of factoring at all?
It's about outsourcing your back office, managing a massive accounts receivable ledger, chasing down late payments from hundreds of clients, and performing credit checks requires a huge accounting department.
Oh, I see.
With maturity factoring, Bharat Biltech is essentially outsourcing their entire sales ledger administration and collection process to the factor for a smaller fee, without paying the high interest rates associated with a cash advance.
That makes perfect sense. They just don't want to deal with the paperwork.
Exactly.
Okay, type 6 introduces a new layer of complexity. Supplier guarantee factoring, sometimes called drop shipment factoring. This happens when the client is a mediator or a distributor.
Let's set the scene for this one.
Let's say Bharat Biltech isn't actually manufacturing the steel beams. They are just a middleman buying from a steel mill and selling to the government. They get a massive order from the government, but they have zero cash to pay the steel mill up front to produce the beams.
In this scenario, the factor steps in and issues a guarantee directly to the supplier, the steel mill. The factor says, produce the beams and ship them to the government. We guarantee you will be paid.
And the mill trusts the factor more than Bharat Biltech.
Exactly, because of the factor's deep pockets. So the steel mill ships the goods. Bharat Biltech, the mediator, raises the invoice to the government and assigns it to the factor. The factor collects the money from the government, pays the steel mill, takes their fee, and gives Bharat Biltech their profit cut.
It's incredible. It allows a middleman to execute massive multi-million rupee trades and generate a gross profit with absolute zero initial financial involvement.
It really is a powerful tool. Finally, we have type 7, bank participation factoring. This is a highly leveraged double financing scenario.
Double financing.
Yes. Bharat Biltech assigns their receivables to a factor. Let's say the factor owes Bharat Biltech a residual amount, their equity in the invoice. A commercial bank then steps in and takes a floating charge on that specific equity.
So the bank lends money to Bharat Biltech based on the money the factor owes them.
Right. It's a way to squeeze every last drop of liquidity out of an outstanding invoice by layering bank debt on top of factor equity.
And as supply chains go global, we also see export and import factoring.
Oh, definitely. If Bharat Biltech ships modular homes to Germany, they use an export factor in India who coordinates with an import factor in Germany to manage the cross-border legalities, currency risks, and collection in a foreign jurisdiction.
We have now mapped out the intricate mechanics of financial services. You understand the arenas, the institutional matchmakers, and the highly specialized delivery contracts like leases and factoring that they utilize.
Which brings us to the final piece of the puzzle, the guardrails, the regulation of financial markets.
We have just described an incredibly fast-moving, highly leveraged system involving billions of rupees, invisible factors, and massive public stock issues. How did India build the regulatory environment to control this without suffocating it?
It required a painful evolution. If we trace the historical timeline, the securities markets originated in India in the 1850s, operating literally under banyan trees in Mumbai.
And for almost a century, it was the Wild West. It was highly unregulated, driven by wealthy brokers with very little oversight regarding market manipulation or insider trading.
Formal control didn't begin until independence. In 1947, the Capital Issues Control Act was passed, putting administrative control over new securities issues under the Office of the Controller of Capital Issues.
Then, the first major structural milestone hit in 1956 with the Securities Contract Regulation Act. This officially brought the stock exchanges under the administration and control of the Ministry of Finance.
And the companies issuing the stock were regulated by the Massive Companies Act of 1956, overseen by the Department of Company Affairs. But while this was an improvement over the 1850s, it created a highly fragmented regulatory approach.
You had different government departments managing different pieces of the puzzle.
And that fragmentation became a systemic crisis in the 1990s, the post-liberalization scenario.
India opened its economy.
Right. Foreign multinationals flooded in, foreign institutional investors brought billions in capital, and the sheer volume, technological complexity, and international nature of the transactions meant the old, disjointed system was cracking under the pressure.
The market was expanding faster than the bureaucrats could track it. There was a desperate, immediate need for an autonomous, unified, statutory regulatory body with the sole focus of supervising the securities market.
And that necessity resulted in the birth of SEBI in 1992.
For your exam, you need to know the 3 core pillars of SEBI's mandate. It is a deceptively simple list, but it defines their entire operational existence.
Pillar 1. Protect the interests of investors in securities. If a company lies on our prospectus, SEBI intervenes.
Pillar 2. Promote the development of the securities market. They don't just police it, they are mandated to modernize it, introducing electronic trading and faster settlement times.
And Pillar 3. Regulate the securities market. Enforce the rules on brokers, mutual funds, and exchanges.
Protect, promote, regulate.
To truly comprehend the scale of SEBI's oversight, look at the data table provided regarding registered intermediaries as of 2017. SEBI isn't just watching the BSE and the NSE. They are regulating the vast, invisible army of middlemen that make the system function.
The numbers are staggering. 64 bankers to an issue, 30 debenture trustees, 18 depository participants, 92 venture capital funds, 45 mutual funds, and the big ones, 187 merchant bankers, and 244 portfolio managers.
Every single one of those hundreds of entities has to file reports, maintain capital requirements, and operate under the strict codes of conduct enforced by SEBI. It is a massive regulatory web designed to ensure that when a retail investor hands over their savings, the matchmaker on the other side is playing by the rules.
And that is the blueprint of the Indian financial system. If you are staring down this exam, let's do a rapid-fire structural recap.
Let's do it.
You have the 4 pillars. First, the markets, the arenas. Capital is for the long-term factory build. Money is for the short-term overnight couch cushion liquidity.
The primary market births the shares through investigation, underwriting, and distribution, and the secondary market provides the liquidity to trade them.
Second, the institutions, the matchmakers, the massive banking tree overseen by the RBI and the Big 5 regulators, with SEBI as the supreme investor protector.
Remember the NBFC trap. They cannot have agriculture, industry, or real estate as their principal business to avoid systemic illiquidity. And development financial institutions do not accept public deposits.
Third, the services. The tricky triplets of asset acquisition. Hire purchase means ownership at the very end. Lease means ownership stays with the lessor, split between finance leases transferring risk and operating leases keeping it.
Installment sale means ownership transfers early, but payments are spread for tax and cash flow reasons. We distinguished merchant banks as fee-based corporate fixers, and we tore apart the 7 scenarios of factoring, from recourse to confidential drop shipment guarantees.
And fourth, the regulations. tracing the evolution from the unregulated 1850s to the post-liberalization creation of SEBI in 1992, designed to protect, promote, and regulate an ecosystem of hundreds of intermediaries.
If you can visualize that city infrastructure, the market neighborhoods, the institutional vehicles, the instrument cargo, the service delivery contracts, and the SEBI traffic cops, you are armed with the exact vocabulary and structural causality you need to dominate the theory and multiple choice sections of your MBA exam.
As we wrap up, I want to leave you with a conceptual challenge. It's easy to memorize this framework and leave it inside the exam hall, but true mastery comes from application.
Take this out into the real world. Tomorrow, when you are driving through your city, look around. When you see a massive new subway line being excavated, don't just see concrete. Look at the invisible web behind it. Was that tunnel funded by a development financial institution issuing 20-year bonds in the primary capital market?
When you see a fleet of delivery trucks for a new e-commerce startup, ask yourself, are those trucks on a finance lease, meaning the startup holds the risk if an engine blows, or are they on an operating lease?
If you know a local supplier who is suddenly expanding their workforce, ask yourself if they are utilizing a non-recourse factoring service to accelerate the cash trapped in their government invoices.
Once you start viewing the economy not as a collection of static businesses, but as a dynamic, interwoven matchmaking service flowing with capital, risk, and regulatory guardrails, you'll realize this isn't just dry textbook theory. It is the invisible code that builds the world around you.
We wish you the absolute best of luck on your MBA exams. You have the mental map. Trust your understanding of the mechanics.
You ready for this? Thanks for taking this deep dive with us.